Hey, good afternoon, good morning, good evening, whatever it is. Thanks for dropping by. Today, we're going to be talking about the economy, what's next, and particularly as it relates to commercial real estate. When is the right time to invest? So, before we jump in, I'm going to give you a moment to like and subscribe because it matters. It's a new channel, and the faster we get momentum, the faster we get the word out. Because frankly, guys, there's a lot to be concerned about in the economy today. The U.S. is leading the world in terms of certain bubbles, but I read about Evergrande. It's a company in China, the largest real estate company in China, maybe one of the largest in the world, period. You have $300 billion in outstanding debt. And that world is falling apart. And if that world falls apart, China's going to get crushed. At least the real estate component of it is. And then the rest of the world will have there'll be some ripple effect. To what extent, I don't really know. But getting back to the point here, like, subscribe, let's get the word out. Let's share what's going on here with a variety of charts. We try not to share opinion. We try and share fact, but that doesn't always work out perfectly. So without further ado, let's jump in. My hypothesis is this: simply that the world, particularly here in the US, is extraordinarily bubblicious. We've got bubbles in virtually every asset class, but those bubbles are starting to show signs of massive weakness, and some of them are frankly collapsing. So those bubbles, they're everywhere. Some of them are starting to show weakness. Some of them are starting to pop. And look, it's not a matter of if, it's a matter of when. Economies move in cycles. And the average cycle is somewhere between 7 and 11 years, from boom to boom, or bust to bust, or boom to bust, depends on how you look at it. Measurement is really, and you'll see later in this video, that how you look at things, how you measure things, can dramatically affect the way you perceive them. And that's the point of charts. Anyways, if you believe that we live in cycles, which we do, I would encourage you to consider that cycles are inevitable. We can't manage around them. It's just the way it works. And it's largely psychologically based. Markets are emotional, and you'll see that as well. So without further ado, let's first talk about what created the bubbles, what asset classes are in bubbles, not specifically everyone, but many of them, and what's going to occur here in the near term that's going to cause those bubbles to pop. Okay, let's jump into it. So let me share my screen. Let's start with my favorite chart here, which is known as M1. It's a primary money supply. It's the money that's incredibly liquid. You can access immediately or within just a few hours. So it's largely what's in your pocket, what's in the bank, what's in your checking account, safe deposit box, demand deposits. It's things that are readily accessible. It's cash that is readily accessible. And so if you look, I'm not going to go in great detail, back here in excuse me, April of 1979, the outstanding money supply in the US was $278 billion. Fast forward to right around the great financial crisis. In December of 2007, our outstanding debt was 1.35 trillion. So we grew, but not dramatically. Like, you don't see any significant jumps here. In fact, you see some tapering periodically. Well, between the great financial crisis and 2020, which is another crisis, obviously, we more than doubled the outstanding money supply. And let me pause for a moment and say why the money supply is so important. When you put cash on the street, when you put cash in people's accounts via stimulus or PPP or any other means, what you're doing is dramatically increasing buying power, right? So you're artificially increasing demand, which in some cases may make supply look like it's insufficient to meet that demand. And in the short run, it obviously is. And that's what's gone on with a lot of the asset classes. But fundamentally, M1 affects our buying habits and our spending habits. The more money we have, the more money we're going to spend. So I don't know if you remember back in 2008, they called the Fed Reserve Chairman Ben Bernanke Helicopter Ben because he threw trillions of dollars out the window. Between the great financial crisis in 2020, we grew the M1 supply. We almost doubled it. In fact, we more than doubled it. We went from 2 to about $4 trillion. That's not what's scary. This is what's scary. It's the most scary chart I've ever seen from an economics perspective. And I'm classically trained in economics. It's one of my dear passions. We grew M1 from $4 trillion, and you can't see the number up here for whatever reason, but it's north of $19 trillion. So we added more than $15 trillion worth of liquidity. We threw it at the marketplace to try and solve the pains associated with COVID-19. The problem is the repercussions are going to be significant. The first repercussion, obviously, is you end up with massive bubbles in virtually every asset class. When you just take the average family, you 5X what's in their bank account. You take their money supply from $400 to call it $2,000. They're going to end up spending that money. That's what we do here in the US. We're consumers. 60% plus of our gross domestic product is based upon consumption. So we're not producing much, but we're consuming a lot. And we're able to consume a lot because of this chart and all the cash we've injected into the marketplace. So that, in fact, is the primary driver behind what's going on in the overall marketplace, whether it's equities or single family home prices or used car prices or new car prices. Lumber was up like 600% until a recent correction. Bitcoin was up exponentially until, again, a recent correction. Virtually every asset class has been jacked through the roof, excepting commercial real estate, which we're going to talk about a bit later. The other thing driving asset inflation is, or bubbles, if you will, is the access to cheap capital. Not only is the money in M1 freely liquid, but the other thing is interest rates are as low as they have literally ever been. So when I talked earlier about perception can really change, visuals and perception can really change the way you view the world. If you look at this chart, you'll say, okay, we started off, this is, I don't know, a 6-year chart. We started here back in 2016 with 10-year treasuries, and 10-year treasuries is just one of the interest indices that we can use. Virtually almost everyone will match this in terms of highs and lows, in terms of movement. But 10-year treasuries is important from a lot of perspectives. Commercial real estate often is priced based upon 10-year treasuries. So if you look at this, you're like, okay, that's not terrific. I see a major decline here. That's largely COVID driven, and we bounced back and we started to decline again. Don't know what that's all about, but let me change your perception. Let's go all the way out. Oh God. So it looks different, doesn't it? What you're seeing is that interest rates are at or close to an all-time low. And this is the 10-year treasury. Again, it's just an indicator, but interest rates across the board are at or an all-time low. Single-family mortgages are at an all-time low, and plus or minus 2 months. So the problem with this is that when you have easy access to cheap capital, your buying power goes up dramatically. And that's really manifested itself in the form of massive asset price increases, bubbles in single family homes. And at this point, there's really no other place for interest rates to go but up. There's some downward movement possible, but it's nominal. It's nominal at this point. And inflation is really starting to hit us hard. And when inflation hits us, it's effectively a tax because our buying power is dramatically reduced. And although, don't trust the numbers produced by the press, don't trust the numbers produced by the Federal Reserve, because those numbers are deeply flawed. Anybody who's been to the grocery store knows that they're paying a hell of a lot more for vegetables, fruits, dairy product, meat's going through the roof. There's a shortage of chicken. I live in California, Laguna Beach. And gas prices are almost $5 a gallon. I remember the last time prices were at that level, everybody sold their SUVs and said, oh my God, the world's coming to an end. I can't drive a gas guzzler. It's not happening this round, but that was a fascinating period. SUVs literally sold at a massive discount. Anybody who had one just wanted to dump it and buy a Prius. It's California though for you, isn't it? So really the only place for interest rates to go is up. And when interest rates go up, it has a dramatic effect on asset prices. So today in Laguna Beach, as an example, people are not buying based upon price points. They're buying based upon what they can afford within their monthly payment. And that's how single family mortgages are underwritten. They're putting on long-term fixed rate debt, which is brilliant, particularly at this price, but they're not considering so much the price of the home. They're just worried about their monthly payment, which, from the long-term strategy makes all the sense in the world. Doesn't matter if your home declines in value by 30%, you're still paying a fixed rate amount and you get the tax benefits through interest rate deduction and writing off other things. But it just makes sense. But the problem is, what happens when this interest rate bounces 100 basis points, which is likely to happen in the near term because inflation is galloping. It's not quite runaway. There's four. There's crawling, walking, galloping, and runaway inflation. We're galloping now, and we're galloping for the first time in 40 years. It's a bit scary. So interest rates go up 100 basis points. That's a 33% increase in the cost of your home mortgage. It doesn't necessarily translate to a 33% reduction in the valuation of your home, but it has a dramatic effect because it limits the buyers who are able to purchase your home. And also it starts having psychologically a downward effect on the way you think about single family homes. Once you see whether it's the stock market or single family homes declining, you start repositioning the way you think about it. Here's another really interesting chart. This is the Case-Shiller index. It's like probably the single national indicator of what home prices are doing. Same home sales. So, okay, so this doesn't look so bad, right? We had that great financial recession, values came down, but note this, price peak there was 184. Price peak over here is 250 something, 255. Excuse me. It gets interesting when you back out though. How about that for a chart? Prices are up. What is that? 400% since 1988. 400% for single family homes. Sorry, but that's ludicrous. Now there's a lack of single family homes available today, and that's largely because in towns, particularly like Laguna, people have second homes, and most of them are sitting vacant literally 90% of the time. It's interesting, particularly a lot of the beachfront homes where I tend to go to the beach and surf and swim. Those homes are vacant 90+% of the time. So whether there's a shortage or not, I don't really know, but I will tell you, when bubbles burst, there tends to be a consolidation. People tend to not move out, and in fact, move back in. So you have familial consolidation, and friends start living with friends, which opens up a whole surplus of inventory. That, in conjunction with the fact that we have upcoming foreclosure and eviction moratoriums that are expiring, that's going to put a flood in the marketplace of new product, and that's going to have a downward effect. So there's that. And then let me just show you one last significant indicator. This is the Wilshire 5000. It is, you aggregate every outstanding corporate equity, every stock, and you put it in a single chart instead of like having an individual stock for S&P, NASDAQ, Russell, and Dow. You've got it all consolidated, added together, if you will. And that's what we're seeing. We're seeing a massive hike. So peak pre-COVID, the market was trading on a relative basis at around 160. And today we're up 224. So we're up, 30% above that high, which, by the way, was ludicrously high. So let's back out and get some perspective on this. You shouldn't be doing that. Right. That, my friends, is the definition of excessive exuberance in a bubble. So value decline. So what's going to trigger the next downturn, which, by the way, it's here. It's here in the next 30 or 60 days. We're already starting to see it. Bitcoin retrace, lumber retrace, copper starting to come down. Precious metals, gold and silver are starting to be flat. Single family listed homes in terms of inventory, that number is growing dramatically. So what's going to cause the next bubble? Well, no one really knows. And if somebody tells you they know for sure what's going to trigger it, don't believe them. Markets are, as I said, emotional, and they're psychologically based. And so we don't know what's going to happen. We don't know what's going to trigger the next downturn, but we know it's going to happen. My perspective is it's going to happen very soon. There are so many at-risk indicators out there. Michael Burry, the famous guy from The Big Short, who famously shorted the market and made billions, says the markets today are dancing on a knife's edge. And I think that's pretty generous. I think it's more like a scalpel's edge. It is so dicey, but there's still so much exuberance in the marketplace that it's ludicrous. So what does that mean? All this put together, there's too much liquidity in the marketplace. There's way too much access to cheap debt, all-time low debt. So we've never had this much liquidity because we've never thrown this much money, $14 trillion into the marketplace. That experiment does not end well. Interest rates have never been lower. So the combination of the two are blowing bubbles up all over the place, and they're starting to pop. What's going to happen when they pop? I don't really know, but I could tell you it's likely to be a bloodbath, far worse than anything we've seen here in the US. Back in 1929, the bubble was the stock market. Well, friends, as you can see, that stock market is massively overvalued. It's more than 3 deviations, more than 3 sigma out from the mean. And Warren Buffett will tell you that we are at great risk for a major market meltdown. The market's melting up. It's going to melt down, guys. So prepare for it. What I wanted to share with you is that we have a company called Invest in Distress. And what we teach people to do, well, a variety of things. One, if you're an existing commercial real estate owner, we'll work with you to restructure your debt, work with you and on behalf of you with your lender to restructure your debt. Rather than lose your asset to foreclosure, rather than potentially end up with massive tax consequences, we'll teach you how to do it. And by the way, I've been doing it for more than 30 years. I've restructured, managed, sold, bought more than $11 billion worth of distressed real estate and distressed debt. So got that pretty much sorted out. The other thing we do is, and it's at this website, Invest in Distress, is we teach people how to buy commercial real estate at massive discounts. My follow-up shows will be talking about that and examples, but I want to share with you that this website exists, which it's really more of a landing page today. We talk about what's going on in the commercial real estate market here. Loan defaults are skyrocketing. The U.S. landscape is littered with distressed real estate. Commercial real estate is bifurcated. There's sort of the residential and then distribution facilities, which are ludicrously overpriced. And then there's virtually every other asset class, whether it's hospitality, retail, entertainment. These assets have been destroyed. There's been massive value destruction as a result of the way we have adjusted as a result of COVID, right? Our lifestyles have shifted, is maybe the way I want to say it. And so we don't go to the mall. We don't go to the movie theater nearly as often as we do. We are just now starting to go out and enjoy a bar or a restaurant. But it's changed the way people think and feel. Business travel will likely not recover for years, if ever. And so you see massive value destruction. One of the videos I have that I'll probably put up tomorrow or the next day talks about value destruction in malls. 4 of the largest malls in the country are the mortgages are in defaults, and the special servicer, the lender, if you will, did valuations on it. They had appraisals done, and they found that in each case, the average value reduction was 70%. Value reduction of 70% pre-pandemic versus post-pandemic. And post-pandemic might be a bit of a stretch, but 70%, guys. Retail is not all that different. So between retail, hospitality, and office buildings too, malls, you name it, the value destruction has been huge. And so virtually every other asset class, whether again it's the stock market or single family homes or Bitcoin, through the roof at prices that are unsustainable. And those bubbles are about to pop. Versus commercial real estate, value destruction has already occurred. And now, my friends, is the time to begin the process of planning to buy. So there's all kinds of really interesting stuff here, but the things that I want to share with you are this. Buying distressed real estate at a massive discount is the single best path to creating generational wealth. And it's never been more accessible. I'll tell you that 4 out of 5 of the wealthiest Americans, whether it's a millionaire or billionaire, earn the vast majority of their wealth in commercial real estate. And there's good reasons for it. And I'll go into great detail in the masterclass, but I'm encouraging you now to go to the website and sign up for this free masterclass. It's going to be held on 9/22 at 11 a.m. Pacific Daylight Time. You can enroll, and then we'll shoot you a confirmation. 2 more things I would share with you. Baron von Rothschild says, buy when there's blood on the street, even if it's yours. Generational wealth will be created as a result of this next buying opportunity. It's not fully here yet, guys. It's going to develop over the next 4 to 6 to 12 months. But the opportunities are going to be extraordinary. And I can give you example after example of people who have made billions. Sam Zell, Tom Barrack, by investing in distressed real estate. I think that's it. Actually, there's a lot more I could share with you, but let's wrap up with that. So my charts proved up that there's bubbles all over the place in the marketplace. I hope you agree. 2, those bubbles are at great risk and some are starting to pop. And we use the example of lumber and Bitcoin and other asset classes. And there's a lot of risk in the marketplace, and that risk, how it manifests itself, I don't know, but cycles occur. We're at the very tail end. In fact, we pushed the envelope dramatically on this one. And so when this bad boy pops, it's not just as in 1929, the stock market declining and that evaporation of wealth. It's a massive wealth destruction because bubbles are going to pop everywhere. Whether it's a single family home, whether it's a continuation of the Bitcoin meltdown, whether it's I don't know, your car, your art, all this stuff, there's going to be value declines and it's going to be significant. And so instead of a single bubble popping, you've got multiple bubbles. And here's my point at the end of the day, it's not something to fear. It's something to capitalize on. Warren Buffett, I think I say this on the website here, says, let's see, maybe I don't have it. But essentially it's this: you sell into greed and you buy into fear. So when everybody else is greedy, you're selling them your assets. When they're fearful is when you're buying their assets. And the distinction is you're selling at the top and you're buying at or close to the bottom. My friends, thank you again. I'd love to hear your thoughts. This is a new channel. We're going to rock it. And any commentary you have is greatly appreciated, good, bad, or otherwise. Like, subscribe, comment, and I hope to see you soon. Have a great day. And